Hey everyone, welcome back to Loan Wealth Academy. If you've ever tried to get a personal loan in the United States and felt confused, overwhelmed, or even frustrated, you're definitely not alone. A lot of people apply for loans without fully understanding how the system works, and that's exactly why they either get rejected or end up paying way more interest than they should. In today's video, I'm going to walk you through the entire process of getting a personal loan in the US, step by step, in a very simple and practical way. By the end of this video, you'll understand exactly what lenders are looking for, what mistakes you need to avoid, and how you can increase your chances of getting approved, even if you're just starting out. And make sure you stick around until the end, because I'm also going to share a few powerful tips that most people don't talk about. And those tips can literally make the difference between getting approved or rejected. So, let's get started. First of all, let's quickly understand what a personal loan actually is. A personal loan is basically money that you borrow from a bank, a credit union, or an online lender, and then you repay that money in fixed monthly payments over a certain period of time. What makes personal loans different from other types of loans is that you can use the money for almost anything, whether it's covering an emergency expense, consolidating your credit card debt, paying medical bills, or even starting a small business. A personal loan gives you flexibility. Now, in the United States, personal loans can range anywhere from around $1,000 to $50,000 or even more, depending on your financial profile. But here's something very important you need to understand. Lenders don't just give out money to anyone. They evaluate you very carefully before approving your application, because from their perspective, they want to make sure that you're capable of paying that money back. This brings us to one of the most important factors in the entire process, and that is your credit score. Your credit score is like your financial reputation. It tells lenders how responsible you've been with money in the past. If you've paid your bills on time, managed your credit cards properly, and avoided too much debt, your score will be higher. And the higher your credit score, the better your chances of getting approved for a loan with a lower interest rate. Most lenders in the U.S. prefer a credit score of at least 600, but if your score is above 700, you're in a much stronger position. On the other hand, if your credit score is low, it doesn't mean you can't get a loan at all, but it does mean you might face higher interest rates or stricter conditions. Now, besides your credit score, the second major factor lenders look at is your income. Lenders want to see that you have a stable and reliable source of income. This could be a full-time job, a part-time job, a business, or even freelance work, as long as it's consistent and verifiable. The reason for this is simple. They need to be confident that you'll be able to make your monthly payments without missing them. Another thing they consider is your debt-to-income ratio. This basically means how much of your income is already going toward existing debts. If a large portion of your income is already tied up in other loans or credit card payments, lenders may see you as a higher risk. Now, before you even think about applying for a loan, there are a few common mistakes that you absolutely need to avoid. One of the biggest mistakes people make is applying to multiple lenders at the same time. It might seem like a good idea to increase your chances, but in reality, it can hurt your credit score. Every time you submit a full application, the lender performs a hard inquiry on your credit report, and too many hard inquiries in a short period of time can lower your score. Another common mistake is not checking your credit report beforehand. Many people don't realize that their credit report may contain errors. It could be an incorrect balance, a late payment that wasn't actually late, or even an account that doesn't belong to you. These errors can negatively affect your chances of approval, so it's always a good idea to review your credit report before applying. A third mistake is choosing the wrong type of loan or ignoring the interest rate. Some lenders may offer quick approvals, but at extremely high interest rates. If you're not careful, you could end up paying back significantly more than you borrowed, which can create long-term financial stress. So now that you understand the basics and the common mistakes, let's talk about the actual step-by-step process you should follow to get a personal loan in the United States. The first step is to check your credit score. There are many free tools available online that allow you to see your score without affecting it. This gives you a clear idea of where you stand and what kind of loan terms you can expect. The second step is to determine exactly how much money you need and why you need it. This might sound simple, but it's extremely important. You should only borrow what you actually need and what you can realistically afford to repay. Borrowing more than necessary can lead to higher monthly payments and unnecessary financial pressure. The third step is to compare different lenders. Don't just go with the first option you find. Take your time to research banks, credit unions, and online lenders. Look at their interest rates, repayment terms, fees, and customer reviews. Even a small difference in interest rate can save you a significant amount of money over time. The fourth step is to check if the lender offers pre-qualification. This is a very useful feature because it allows you to see potential loan offers without affecting your credit score. It's a great way to explore your options before committing to a full application. Once you've chosen the right lender, the next step is to fill out the application. This usually involves providing personal information, employment details, and financial data. Make sure everything you enter is accurate and honest, because lenders will verify this information. After submitting your application, you'll need to upload supporting documents. These may include proof of income, identification, and bank statements. The approval process can take anywhere from a few hours to a few days, depending on the lender. If your loan is approved, the funds are typically deposited directly into your bank account. At that point, your responsibility is to make sure you repay the loan on time every month. Missing payments can damage your credit score and make it harder to borrow in the future. Now, before I wrap up, let me share a few powerful tips that can significantly improve your chances of getting approved. First, try to improve your credit score before applying. Even a small increase in your score can lead to better loan terms. Second, reduce your existing debt if possible. Paying down credit card balances or other loans can make you look more reliable to lenders. Third, always choose a lender that matches your financial situation. Some lenders specialize in borrowers with excellent credit, while others are more flexible with lower scores. And finally, never provide false information on your application. It might seem tempting, but it can lead to immediate rejection or even long-term consequences. So that's everything you need to know about getting a personal loan in the United States. If you found this video helpful, make sure to hit the like button and subscribe to Loan Wealth Academy for more content on loans, credit, and smart money strategies. And let me know in the comments what topic you want me to cover next. Maybe how to increase your credit score fast, or how to get approved with bad credit. Thanks for watching, and I'll see you in the next video.